So this is Anna Pinedo. I'm a partner in the New York office of Mayor Brown and the co firm's Capital Markets Group. And I'm joined today by Kevin Gazelle of NASDAQ Private Market and Angus Welchel of Moelis & Company. Very pleased to have Kevin and Angus with us this afternoon to share their insights and provide market context as we talk about updates and the late stage private placement market. Obviously, a lot happening as we deal with the downturn in the equity markets, and I'm sure that the audience will have questions on how that's affecting investor appetite, valuations, and private company behavior. So we will talk about all of those things during our session.
First, I think what might be worth doing is just going to the next slide to talk about the market. And obviously it's very topical right now. So maybe I'll just run down where we are. And this is as of half an hour ago, and things are changing rapidly. So don't hold me to the numbers. They could hopefully be rallying by the end of the day. You never know. But the S&P's, officially really in bear territory right now. And that's all markets. Actually, this S&P's, roughly down about 23% year to date. And within that, there are some bright spots like energy, which is up almost 50% year to date. But really, you're seeing a lot of weakness, particularly in consumer discretionary communications and call it information technology, as well as just the tech complex in general. NASDAQ on that note is down 33% year to date. Dow Jones down 18%, just broke 30,000 today. And really a lot of that's on the back of the CPI data that you guys have all heard about from Friday, and a little bit of a muted response from the rate increase that the Fed did yesterday of 75 basis points, which is rather large in the context of historical rate increases. The next meeting for the Fed's in July, so we'll see what they do there, whether they go for 50, 75, but nonetheless, the direction is up. And I think you're seeing a lot of volatility in all markets. You're seeing the VIX is up 90% year to date. You're seeing an inverted treasury market between 7s and 10s, which is just recently happening, but a very steep curve going up to 5s and 7s, and an incredible movement in rates overall. That's affecting the high yield bond market. In fact, if you look at year-to-date volumes, they're down 75%, around 66 billion year-to-date versus 2021 year-to-date of 260 billion. So it's pretty impressive to see that type of movement in terms of volumes. If you look at the investment grade market, it's actually flat on last year to slightly down. But a lot of this is feeding into the consumer as well. You've seen mortgage rates are cresting 6%, which is the highest it's been in a very long time, even since probably 2008. And average loan prices outstanding are in the mid 90s now. In fact, there were some loans getting priced today and bonds getting priced today in the, call it 90-cent area, and the average trading for notes and bonds now is so high 80s. So pretty impressive volatility affecting all markets. Interestingly, many companies who, for all of those reasons, including some of the concern around the war in Ukraine with Russia, are unable to access the public markets, whether that's debt or equity, or are thinking about alternatives. And the good news is the private market has shown some resilience. If you look at year to date for just US-based companies raising capital, and we track over 50 million in proceeds on the capital raise, you've seen a little bit of an uptick from last year, about 99 billion. But I find it really interesting to compare it to the US IPO market, which, depending on how you look at it, is around 6 billion. So, there's been a lot of issuance. I think what's the big question, I think, for the rest of this year is how do the public markets feed into the private markets? And I think you're starting to see a little bit of weakness in some of those late stage private rounds that are getting done. However, I think the good news is that there's a lot of creativity out there not only amongst the buy side, but amongst the intermediaries like myself and colleagues across the street, as well as issuers who are starting to want to listen in terms of how they can raise capital, perhaps not in a non-diluted way or in a way that doesn't affect their future valuations. So I think if you skip to the second slide, we'll get into this a little bit. Look, we've talked about the influence of this market on the public side coming into the private side. Usually there's a lag, at least in my read of what's going on. It's happened a little bit more quickly than in a normal environment, and almost within months, as opposed to a lag of 6 to 9 months, which we sometimes have seen in previous downturns in public markets. Late stage private rounds are certainly an alternative for companies who were thinking about doing a SPAC combination or going public through a traditional IPO. But with that, I think there are some elements to think about in terms of structure and downside protection with minority transactions. What I mean by that is we're seeing more defensive type moves from the buy side, increased liquidation preference, so that if there is a down round in the future, the investor coming in now gets not only their money back first, but gets a little bit of a return, or even more of a return than they would have gotten perhaps in a deal this time last year doing a deal. In addition to that, more governance coming into the equation. And in some cases, you're seeing what have been traditionally more VC-like structures called participating preferreds, or double dip type preferred structures coming into the growth rounds as well as a discussion point around negotiation to get the deal done. In addition, for companies who are trying to avoid putting a mark on the business right now for obvious reasons, insider rounds without valuations and a discount to the future round are becoming more prevalent, which allows you not to go out to the market, but stick to your existing investor base. Also thinking about things from a defensive standpoint, as opposed to an offensive standpoint when it comes to capital raising. And what I mean by that is companies who really need to raise capital versus those who are doing it opportunistically. So secondaries become a little more tricky to execute, or companies are starting to think a little bit more about whether they need to strain their balance sheet and their valuations to afford a secondary for existing investors. Maybe put that off and think about what really needs to get done. This is a little bit offset by, we've all been talking about this, we've all seen this significant dry powder in the private equity community who's actually stepping in where some of the more growth-oriented investors have either stepped back or put a pause on investing. And I think that's really helpful for companies who are looking for defensive capital. It's perhaps a little bit more expensive and there's a little bit more structure to it, but it is something that's out there. And I think a lot of companies that need the capital are finding it. It's just a little bit different to the way it was in 2021 and actually the previous few years before that. I think if you go to the last page in my presentation, it's really interesting to think about unicorns. And despite what we would say is a very volatile market right now, and in some cases, almost one of the most volatile times we've seen from a standard deviation basis, you're still seeing companies that are hitting unicorn status at a record pace. In fact, year to date, from our tracking, there are more unicorns that have been generated from last rounds of financing than all of 2020. 2021 was a record year, probably might not ever be repeated, who knows, but you can see and you can feel it from last year at how ferocious the appetite for growth rounds were coming into IPOs. We think there's going to be probably on the right-hand side, that down round bar or that color is probably going to increase going forward as companies think about raising capital. You're already starting to see it. There was an article, and many of you probably saw it in PitchBook yesterday, which is indicative of how a lot of us are feeling. It just kind of put pen to paper on what a lot of investors and banks and issuers are seeing, is that they're getting a little pressure on rounds. Now, look, if you look at the number of unicorns in 2021, You could say perhaps there was a little bit of froth in that, and those same companies doing rounds perhaps in 22 or 23, particularly growth companies, those are the companies that are probably going to come under some pressure as it relates to valuation, hence trying to think about either non-dilutive capital or inside rounds, or again, defensive needs. One aspect we're seeing, I mentioned, is the non-dilutive capital. And I think it's worth just mentioning that a lot of the traditional venture capital and growth investors that we see at the bottom have put a lot of money to work in the past couple of years. And some of them are perhaps hitting pause or being much more careful about where they put their money. But what that's allowed for is investors, sovereign wealth funds, pension funds, in some cases, insurance companies, corporate VCs, and also family offices to step in and provide, as well as the private equity dry powder we talked about, to provide non-traditional, non-dilutive type capital. So what does that mean? That means we're seeing a lot of what are called redeemable preferreds that don't convert into equity, that provide a fixed return for the investor, perpetual preferreds that don't have a put right, but have step ups and returns to induce issuers to prepay at some point in the future. Again, non-convertible, growth debt, term loans with perhaps warrants, things like this, particularly within software companies that have subscription-based revenue streams. So these are things that you're probably gonna see more and more in 2022 for companies that are looking to raise capital in the private markets, or for those companies that perhaps don't have access or continue to not have access to the public equity markets or the public debt markets. And so it's a really interesting time. I think the relationships, creativity, and content win the day in terms of attracting the buy side, but also I think product positioning and durability of cash flows for those businesses that are growing is going to be really important to getting deals done. I think I may stop right there just to see if there are any questions.
Angus, a couple of things. So on the unicorns, yeah, obviously the growth in unicorns has slowed from the epic pace of 2021, but to your point, it's still at 203, right? It is still on a historic basis. We're still looking at elevated levels of continued, let's call them unicorn births, right? So if we're looking, just taking a longer view, that's not slowing yet, or you're not seeing that affected. Is that a fair statement?
I think year to date, I mean, obviously this is a backward looking. Some of those deals that probably were executed may have been being negotiated even as far back as December, January, where we hadn't seen the volatility tick in. I think it's going to be really interesting, at least from my perspective, to see what the third quarter look back is like in terms of where rounds are. I think, like I said, I think you're going to see on the right-hand chart, the number of down rounds and flat rounds versus up rounds is probably going to increase on a relative basis. But also, in addition to that, the volume of activity is probably going to decrease as well. And so you'll start to see less of that. And what's also interesting is, how many of that 586 number that we count ultimately will end up being unicorns at the next financing round. That's where I think you're going to see, and it feeds right into the down round, flat round type synopsis. But it may be a bit clouded by a couple of things. One, companies who just decide not to raise financing in the volatile times, and they have enough cash flow generation as well as dry powder in their balance sheet to withstand a long period of time. Number two, inside rounds, which tend to not have valuations put on them with existing investors, and in some cases, it's self propelling in terms of the existing investor not having to put a mark on an existing investment. So it's incumbent on them to support their businesses that way. And three, like I said, non-dilutive capital instruments, like putting more debt on the balance sheet. And there's a lot of investors who are starting to think about those ways of deploying capital, as opposed to like taking more risk by being at the bottom of the stack with equity.
Sure. And so you mentioned sovereign wealth funds and corporate VCs, CVCs, which I'm going to talk about in a little bit, and family offices. What about credit funds? So we do a lot of work with credit funds, and credit funds seem to have a lot of cash available to deploy. Are you seeing credit funds active?
Oh yeah, I mean, absolutely. I mean, if you think about the fundraising for, and what I mean by private equity firms, it's a lot of private equity firms who have sleeves of capital that are opportunistic, quote, which can do preferreds, which can do debt instruments, which can do a mix of common and preferred, or common and debt, like strip financing. And they're very solutions based. You hear that word a lot. But yes, there are also a lot of the standalone credit funds that have stepped in. In fact, there's, if you look at the dry powder that's been raised from a lot of those, PE and credit funds, it's over 200 billion right now sitting on the sidelines, versus last year was around 74 billion. So it's really increased. I think people have tried to position themselves. You've seen a lot of mega funds being raised as well. And you're seeing the big hybrid capital type funds, such as Apollo and Carlyle and Oak Hill and Oak Tree, really stepping in here. And I think that's gonna help a lot of the people who need to raise money. And the other thing I think you're going to find is that, I mean, that capital really attracts itself to private financings. And I think you're going to see much more of that, and many more companies, even public companies, looking at that type of capital as a way to keep themselves going. In fact, if you think about the IPO market, and let's just drill into that and look at just de-SPACed companies. So these are companies that have merged with a SPAC and now are publicly listed. I think there's a huge opportunity for that type of capital to help those companies who are growth companies, who still need to raise capital, but perhaps don't have a shelf registration yet. They're too early, and don't have a lot of other options from the standpoint of doing a standalone S1 to do a public follow-on offering, or don't have an ATM in place. The private market, structured pipes or debt instruments are going to be very much in vogue in 22, I think.
Absolutely. Yep, we agree with you. All right, well, thank you. So maybe we'll turn to Kevin to talk a little bit about what companies are doing in terms of secondary market transactions, liquidity for employees and earlier holders, and how that compares and contrasts to 2021. So Kevin.
Thanks, Anna. And great info, Angus. And I think it leads into a lot of what I'm going to talk about as far as what we saw last year in 2021 in comparison to what we're seeing thus far in 2022. It's certainly a different time. It actually feels like I was saying to someone the other day, one of our long-term clients, that like 2021 feels like 5 years ago for some reason. I don't know why. Maybe it's also just because of the pandemic and everything else. But so we can go to the next slide, Melissa. Maybe we'll start kind of what we saw last year with some stats overall in the market. It was an incredible year overall, obviously on the public side, and for NASDAQ, obviously they saw record numbers of listings. For us on the private side, we obviously also saw record volume in terms of transactions, valuations, and everything. So a couple of things just kind of highlighting, I think the bulk of the companies that we are seeing who want to structure broad-based liquidity programs either on an annual basis or a biannual basis have hit that unicorn status, which I know it's a little bit of a blurred line now in terms of what a unicorn is. But typically they are companies that have, raised at least a Series C round or more. I will say one thing last year, which was also unique in the market. We also started seeing this, in the second half of 2020, earlier stage companies, Series A and B, who, were coming off of, we call them, mega raises. So, raises in the $100 million range. We saw several companies who looked to provide some liquidity at that stage, which is pretty remarkable. I'll say this year in 2022, I'll say that's a big shift. We're not seeing that anymore as far as, the earlier stage companies, looking to conduct secondaries right now. I'll say I think it's more in line with the later stage, probably $2-3 billion and over companies who are still kind of trudging along and still running, their normal secondary processes. Also uniquely, I think just as far as, I think one of the cool things in our market, we continue to see this year, which is also a really interesting feature in the secondary world, where a company's located, right? I think the idea of like a secondary, from when I was first doing this at Second Market many years ago, was a very Silicon Valley centric, I think, idea, right? To provide, like, offer folks to sell some of their equity to get liquidity. That's shifted where we now see companies all across the US, but also we've seen just an explosion amongst international clients who are really starting to understand the value of liquidity in the private markets as well. So we continue to have a lot of traction in certain regions like Latin America, Israel, Europe. We are just starting to see now a little bit more in some of the African countries as well. So it's exciting to see, more international companies getting to a stage where they can start to consider some broad-based liquidity for their employees. Again, I think the majority of why, right, companies do this in terms of, looking at the program terms, it's for your employees first and foremost, right? The idea to allow, your long-term engineer who's been with your company for 7 years to sell 20% of their equity is a really powerful retention tool. And it's also continues to be that way for companies. The recruitment retention idea was the reason companies started doing this many years ago, and that still holds true for many companies. And so I mentioned the 20% threshold. You can look at common restrictions. That's kind of the median what we see for companies when they're allowing folks to sell. They're usually in that range of 20% of vested equity that they allow people to sell in a broad-based program. Common being the most preferred. Certainly we see a lot of options. Oftentimes we'll see folks who have options be allowed to do like same-day sale and exercise with those options. They don't have to actually, cut a check. It's very beneficial to the employees. And so some of the transaction data on the far right in terms of, this is, I think, interesting. We talked about some of the structures, maybe starting at the bottom, but historically, you think about how to structure a broad-based program. Typically, it's going to be where the company is repurchasing those shares, right? Or there's existing or new investors that are coming in to purchase those shares. From about 2013 to 2019, it was really 50-50, very close, where we would see, third-party versus company repurchases. Then we started seeing more of a shift towards third-party transactions. And last year, there was just much more of an explosion geared towards third-party transactions because there was such avid investor demand, investors that were really trying to get additional allocation in companies, whether they didn't get enough in a primary or, companies were using the secondary as a great tool to bring on new investors. The next slide, please. And just some additional stats, kind of some of what I mentioned. I think this year, again, if you look at those, the clients by recent financing stage, certainly I think Series C, I would call it Series A through C, is closer to the 10% range right now in terms of what we're seeing overall. I'll say the Series D and over, that continues to be probably more towards the 20% range, each of them 20% range in terms of who we're interacting with and seeing who are still wanting to provide liquidity. And the far right there, again, kind of, this is I think, people are asking right now on a daily basis, like, what are you seeing in the market as far as pricing, right? I think, Angus and Anna, you both mentioned debt being a trend. I think we are also starting to see that as well. We had, I think, last week alone, we talked to 2 different companies who are in the process of raising debt rounds and who are thinking about still attaching a secondary on the back half of that. And that's unique. I'll say that we would see that once in a while, but right, typically where we see most companies that are raising equity rounds and close their primary and then will run the secondary process typically soon thereafter, maybe right after, or usually within about a 4-month period. And a lot of that reason is because you have that fresh price there, right? It's a great indicator as far as pricing the actual liquidity event. So if you have a preferred round, I think historically again, 5, 6, 7 years ago, we would see discounts in the 20 to 30 range as being very common. And then right after the pandemic started to, I guess, where people, I guess, came back to a little bit of a normal life in the second half of 2020, we saw that discount shrink greatly. And then last year, by and large, most of the programs we saw were on par with the prior preferred round for most companies. We were even seeing many programs where companies were running them at premiums to the prior preferred round, which is very unique in the market. That we're not seeing this year in 2022, which again is certainly understood with valuations coming down. I think some investors are also have kind of toned down their participation, we'll say. You think about who we see in the secondary market. There's a broad range of mutual funds, sovereign wealth, secondary funds, growth equity, asset managers, hedge funds, family offices. But we would see a lot of the same players, the Cotus and the Tigers of the world, who are not participating nearly as much. However, I will say the discounts we're seeing right now in the market are not as drastic, I think, as most people think. We're seeing discounts typically now in the range of 5 to 10% off of the prior preferred round for companies. And that's more in line with what we were seeing like in the 2018, 2019 into 2020 range. So I think that's also expected in the secondary market. I think what we saw last year, as far as a lot of the programs being at the preferred or premiums, is really the anomaly in this market. So I think there has to be some expectations set maybe moving forward. However, I also don't expect us to see the discounts we saw 5 to 7 years ago, where it was like constantly 25, 30% across the board. I don't expect that either. We have, on an occasion when we are facilitating direct secondaries or block sales for founders or early investors, we are seeing some steeper discounts. But a lot of times that has to do with also information sharing, which I'll get to in a little bit. Next slide, please. We can go to the next slide. Sorry, I think the next one speaks better. Thank you. So you think about the different types of structures in terms of kind of how we interact with companies. I'd mentioned the block sale capacity, where maybe 1 or 2 individuals or former founder, executive of a company is just looking to sell some of their equity. We have a bench of over 200 institutional investors that we leverage to help them. But the most common structures that companies are implementing for their employees, and it still is, the tender offer. And I think there's a lot of flexibility in the tender offer. I think it's the easiest type of structure for your employees to understand. And we've also seen over the years that participation overall increases year by year in these types of programs. And I think like the old way to look at it, when we were first engaging with companies years ago, and they would say, well, why would we want to let people sell or take some money off the table? Like, we're really bullish about our company, which is great. We hope that most companies say that. Again, it's a wonderful recruitment and retention tool for your longstanding employees. It's also a great way to clean up your cap table and get some former employees or investors who aren't aligned with your company anymore and get them off the cap table. And that's some of the beauty in a tender offer, where you can implement different sellable restrictions for different groups of people, your current employees versus your former employees versus your investors or founders. I think one of the unique things we're seeing this year, and a shift that we started seeing last year, is towards alternative structures in the market, whether they be auction structures or what we call like company marketplace structures. And a lot of this has to do with, kind of letting buyers set the price. So we can run dual-sided auctions, and we've seen more and more companies implement this, or a Dutch auction. Or we've seen some companies who have leveraged what we call like a buy-side auction into a tender offer, where you're really kind of creating a competitive bidding process amongst buyers to see what kind of price you can get, and then you use that price in the tender offer. Typically, this is going to be best suited for again, a pretty high growth, well-known private company. But it is a unique structure, and we're seeing more companies, look to us and also look to the investor network to see where they can price their shares. Another unique structure, reason why companies are doing these secondaries and are utilizing what we call the company marketplace structure, is to kind of harness all the secondary trading. Sometimes we, talk to companies who have a lot of one-off secondaries that are going on, and they have to handle all these transfers, and it's frankly just an administrative nightmare. So for two companies that are now public, but Asana and Coinbase, before they went public, we ran kind of a and centralized order book process where we were matching buyers and sellers every week or two for about a 3-month period. And for those two companies, they were interested obviously in harnessing a lot of their trading, but also getting a reference price prior to their direct listing, which is, I know, is a bit of a bigger trend, last year, the year before. So it was a great way for them, and a real way for them to get an indicative reference price before they hit the public markets. So we're seeing some unique structures, or I think more and more unique structures. We're having more of those conversations where, the tender offer, again, is a wonderful solution for companies. And again, it has a lot of flexibility. I think it's, again, the easiest type of structure for your rank and file to wrap their heads around. But there can be better solutions where you're, if you want to, use the buy side to figure out a price, or you just want to conduct a higher cadence of liquidity for your employees. There are other types of structures that we're seeing. Next slide, please. And so I think this is really helpful to see overall, and I can talk about a little bit of the best practices in terms of like the documents and the disclosures that go into the process for broad-based secondaries. But typically when a company wants to offer broad-based liquidity, the process in and of itself is going to take at least, we always say, about 2 months. And I think some of the things, right, that companies have to figure out, even prior to engaging with us, although we're very helpful with all this information, is just setting the rules and parameters around the program. So understanding, obviously, who's going to be buying, if you have the buyers lined up, and how much you're going to allow folks to sell. So putting those rules in place. Also trying to, if you kind of look at it, it's a little bit of you're trying to do, it's a little bit of a math and science process, but you want to look at what kind of buy side demand you have and align that with what you think you're going to have on the sell side. And often companies will also allot for oversubscription, where if they think, okay, we have $20 million of buy side demand, but if we let everyone sell 20%, whatever the case may be, we could hit 24, 25 million. So their cutbacks are needed. And for fairness, what we typically see as best practice, usually you're allowing, you're implementing those cutbacks last on your employees. And you can also put a preference around what folks want to sell, are allowed to sell from first. So like in our platform, we have a priority feature where they can choose what type of equity they want to sell from first. But all these rules are kind of set out in place. And then there's typically going to be an offer to purchase that's involved, right? Which is the document that is either between the company or the buyer or buyers, outlining all of the parameters of the transaction, at what price, who's buying, and a letter of transmittal. And then the various disclosures that we typically see, typically it's going to be 2 years of audited or unaudited financials. Certainly if you have the audited, we always recommend it. Some companies don't have them yet. Your bylaws, your certificate of incorporation, summary cap table, risk factors, any relevant stock plans. But we always stress that disclosures are really important. One, to help people make an educated decision, but we also stress that it's important to provide the same disclosures for the most part to both the sellers in the programs as well as the buyers in the program for symmetry of information. There are the occasion where we're going to see like in an investor deck or projections that are shared solely to the buy side versus the actual sellers. But overall, we recommend there being kind of symmetry of information and those disclosures being shared with both sides. And all that's housed in the platform for folks to be able to view and then sign accordingly. Once the offer goes live, typically if it's going to be you're going to have to abide by the US tender offer rules. Again, in some cases for auctions, you don't need to, but typically for the tender offer, it's going to be open for the 20 business days. So you figure about a calendar month where individuals are going to be able to go into the platform and execute and choose what they want to sell. They also have the option to edit or change or cancel their order at any time. It's also one of the really nice features in a tender offer, why legal counsel typically likes it a lot, because again, this is giving people an opportunity to sell. It's not forcing anyone to sell, and they can change their mind at any time. And then the settlement phase typically just takes about 6 to 8 days for cash in hand to those individuals. Typically, we are acting as the paying agent, so we handle the flow of funds between the buyers and the sellers and help the company as far as any type of exercise costs associated if people are exercising and selling. So that's the most common process. There are the alternative structures that I mentioned, but I think that this was the structure we started to see 10 years ago in the market, and it still holds true as being the most common in the market. And I think again, I was mentioning earlier, I think we've seen participation increase over the years in these types of programs, partly because I think your shareholders are just more sophisticated and understand their equity more these days. I think we've had these conversations with founders and CFOs of many companies who have told us in just the last 2 years alone, when they interview people who to bring onto the company, that folks ask in an interview process, do you provide liquidity at all? And that's a pretty unique thing. I think that wasn't probably asked 5 or more years ago, whereas it is asked today because many companies have to compete with either public companies or other private companies who do provide this. So I'll stop there and pause maybe for questions.
Kevin, that was really very thorough. So thank you. I don't think we have any questions right now. Maybe we'll just continue just in the interest of time. And I'm sure folks can reach out to you if they have questions on the process. So just to hit a few of these, and I'm not going to go through these in great detail. So we outline on the next couple of slides really the topics that are of greatest interest for crossover funds, to distinguish them from the negotiating points that traditional venture capital investors focus on when they're investing in earlier stage rounds, and to really make the point that later stage investors are more focused on the economic return and ensuring a minimum rate of return generally, and monitoring the health of the company, as opposed to ensuring that they're going to have an active governance role or management role in the company. So oftentimes the structure is preferred or convertible preferred. To Angus's point, we have in prior periods where we've experienced volatility or downturns in 2009 through 2011, again in 2013 through 2015, and now most of the term sheets have been for redeemable preferred, as Angus was pointing out, or perpetual preferred, or first lien with a kicker, with a warrant kicker. I should say, just point out that the redeemable preferred and perpetual preferred, while those technically are equity securities, and have a lot of the features that I'm going to talk about, they generally will be, for accounting purposes, balance sheet purposes, treated as debt. So to the extent that the company has, for example, in its charter documents or in other operating agreements, material contracts, limitations on indebtedness or covenants relating to indebtedness, they might want to take into account and talk to their accountants, and understand how an instrument like a redeemable preferred or a perpetual instrument is going to get booked for accounting purposes. Regardless of whether it's a redeemable preferred, a perpetual, or a more traditional convertible preferred that you see in a late stage round, the late stage investor is going to focus largely on protecting their interests through negotiating pretty robust affirmative and negative covenants and negotiating for themselves. If it's a convertible preferred, then a separate series vote for on a number of matters. We highlight some of those information rights, certainly, again, to make sure that they understand how the company is doing. Something that becomes, that sort of comes in and out of vogue depending on what the market is doing, are IPO and M&A ratchets. So of course, given the environment, we're seeing those. I don't think that we're going to see a near-term return of the IPO market, but if investors are looking to a 2023 IPO or a 2023 liquidity event, then an M&A or an IPO ratchet designed to ensure that they get some minimum price protection or a minimum investment return for their investment becomes a very important negotiating point. And that is something that certainly is making a return. So maybe we'll just go to the next slide. Lockup provisions always get negotiated at the time of investment. As I mentioned, for late stage investors, having a governance right is seen as a detriment, not a plus. So it's generally an observer right, so that they're not considered an affiliate and aren't impaired from selling going forward. Generally a preemptive right, and often, but not always, a drag. So those are some highlights. We'll move along we'll skip to the CVC because I think Kevin did a phenomenal job covering all the secondary issues. To Angus's point, there's been more CVC activity. So while historically corporate venture capital had focused on early stage companies and early stage investments, that's been shifting some. And we're seeing more CVC investment in later stage companies, but more of this is coming in the form of an investment and a strategic partnership. So we'll go to the next slide, Melissa. So a lot of these are coming with, as I said, collaboration agreements, licensing agreements, joint development or supply agreements. And so oftentimes negotiating the investment agreement at the same time that the commercial agreement is being negotiated may bring the CVC into conflict with the company's existing investors, which principally have financial interests at stake. And so there may be conflicts of interest to take into account. We'll go to the next slide. And we'll skip to the next one. There are also some distinct negotiating issues for strategic investors. So always with a strategic, you want to take into account whether as a company, you want to limit, for example, transfers by the strategic to your competitors, and how you want to define and think about that universe of who your competitors are, whether you want to update and keep some control on identifying that universe of competitors, whether you want to even limit or have the ability or negotiating leverage to limit the ability to invest in competitors, and again, how you define the competitors by product, by field of research, and so on. We'll go to the next slide. Standstill provisions may be very important if an M&A exit is perhaps more likely than a direct listing or than an IPO as an ultimate liquidity opportunity. It may be important to have a standstill provision so that the strategic isn't seen as the obvious acquirer or as having an inside track to acquire the company, and therefore make the company a potentially less attractive target, or a target worth less of an investment of time and effort in for other potential strategics or other potential acquirers. So oftentimes a standstill will be negotiated for certain percentage interest or certain agreed to transfer restrictions, so that can be fairly contentious. Next slide. The strategic may want a right of first offer or right of first refusal to have an opportunity to look at an acquisition of the company. Again, the board may want to carefully consider whether this is effectively giving away any kind of value in or leverage for the company when it's considering an opportunity to affect a strategic transaction, and whether because the strategic has information rights and may be privy to confidential information, it has already effectively shared a little too much. So all of these are things to think about. By no means a complete list, just some things to think about as CVCs become much more important in the late stage landscape. So we'll move on to some regulatory developments to keep in mind. So the SEC in November of 2020 made some pretty significant changes to all of the rules relating to private placements. Those changes became effective in 2021. Among those were really wholesale changes to all of the rules relating to the integration of securities offerings. I'm not going to go through those in detail, but the upshot of all of that is that now, in an environment like this one, where it is more challenging for companies to raise capital, and companies need to be really nimble and preserve their optionality and potentially contemplate doing multiple private placement transactions, or may want to stop and start various private placements, or undertake a private placement, let's say of a redeemable preferred, a convertible preferred with different investors. It's important to keep in mind that there's enhanced flexibility with this new rubric of guiding principles for integration. And then on the next slide, we'll go onto the next slide that has our little chart. These 4 non-exclusive integration safe harbors that make it far easier for companies to undertake concurrent private placements, including private placements that involve general solicitation and private placements that prohibit general solicitation, to undertake them concurrently, as well as to undertake private placements in rapid succession with only a 30-day window separating them. So all good things. Likewise, much easier to undertake a private placement followed by a public offering or to undertake a private placement while a public offering is undergoing. So good to have that in the back of your mind. Next slide. The SEC just a couple of days ago put out new guidance. This is an area that the SEC is very focused on under the Gensler administration. So a number of companies that do not pursue the route that Kevin was talking about of providing liquidity for employees and early holders leave employees and executives with few options, and some of them decide to go to providers of liquidity through forwards. So there are a number of companies that will write forward contracts for holders of restricted stock of private companies. This is a pretty big business or has been historically over the last few years, pretty big business on the West Coast. Counterparties writing forward contracts on restricted stock, particularly of unicorns. And it's a way for employees, for early holders to monetize their position. And what the SEC came out and said just a couple of days ago is, if that's restricted stock and it's contractually restricted because of, let's say, a charter document, right of first refusal, preemptive right, all of those things which exist in almost every private company charter, then it does not qualify, the forward contract doesn't qualify as one that's intended to be physically settled, which if you're a derivatives lawyer, you know is a horrible thing, because then it requires compliance with a raft of Title VII rules, and means that you can only enter into such an arrangement, which it then makes this a swap. You can only enter into such an arrangement if you're an eligible contract participant. So it really kind of shuts down this business, but a handful of market participants, unless the company in each case wants to waive the contractual restrictions. And usually most of the participants that were going the forward route because the company wasn't cooperating and wasn't wasn't going the way of sponsoring a liquidity program. So this is pretty significant and something to spend a little bit of time on if you're with a private company or looking at monetization schemes. And so last topic is, and that's the text of the CNDI, which is question 101.01 on the SEC's website. So the last thing is sort of what's ahead, which is more of a, what to watch for from the SEC. And this we expect all to come in the next 2-3 months based on the SEC's publicly announced regulatory flexibility agenda. So SEC commissioners have made various speeches, and the SEC's published agenda includes at least these 3 things, which is enhanced regulation of private companies. So the SEC intends to modify the Section 12G threshold to make it such that private companies would have to become subject to some form of SEC reporting earlier. And the underlying premise here, which is questionable, is that there's too little transparency as it relates to unicorns, the securities of which are broadly dispersed, and that may pose investor protection issues. Now, for those of you that are securities lawyers, you may recall that in 2012, when the Jobs Act was passed, we amended the 12G threshold to make it possible for companies to stay private longer so that they didn't have to be forced into public reporting. So this would be a big change. And then proposed amendments to Regulation D. This would revive the much hated proposed amendments to Reg D, which were never adopted because most of the legal community panned them. And this would require the filing of a Form D in order to meet the conditions for 504 or 506. And then revisiting the accredited investor definition, which was made more expansive to make it narrower. So we will see where all of these come out, but we'll leave you with those concluding thoughts. So as I mentioned, we'll circulate the recording and the materials. Thanks to everyone for joining. So that concludes today's program.